So now we switch from all right, we switch from real estate to climate and sustainability. We have Aman. Okay, I'll turn it over to Aman and Sonia. And, sorry? You can introduce. So we have Aman and Sonia joining us. Aman, serial entrepreneur. He's also advisor and investor to multiple startups. Few years ago, he had a successful exit. Now, for the last about 3 years, he's been running the NFT Brewery, and they're doing some really cool things in Web3, in Web3, and using blockchain technology. And joining him is Sonia Chawla. Great experience, ex-PagerDuty. Now she is SVP heading sales strategy and operations at the Climate Impact Partners, right? Did I get it right? At Climate Impact Partners. So they're going to talk about sustainability and what's going on with Web3. We also have a guest speaker who will be joining us remotely. I'll let Aman introduce them. So without further ado, let's give it up to them. Thank you. I'll pick this up.
Well, thanks, Tanvir. Thanks for having us. And it seems like a pretty interesting panel to be part of. And to just give you a little bit of a background about myself, I'm Aman Johar, the founder of the NFT Brewery. And what we're doing is pretty interesting because we are bringing new revenue channels and opportunities to enterprises. And the way we do it is using AI to surface good data from the enterprise databases and putting it on chain to make it transactional. And the transactional part is where it intersects with the real world when you're trying to buy and sell real world assets. And in keeping with that line, what we've realizing is that the NFT part of it starts to become a little bit of a limitation outside of this room. So we are changing the name to a company that'll be now called Data Curve. And it'll be happening soon. So very excited about that. But to kick off the panel here, I do have here with me Sonia, who's with the Climate Impact Partners, and also Dave Timms, who's the co-founder of another company called Carbon CX. And Dave is based in Calgary, so it's probably from a good to not have him here and contribute to a larger carbon footprint. So we have him online. So without further ado, I'll let Sonia introduce herself and quickly Dave as well after that.
Sure. Good afternoon, everyone. I was impressed. Both of them didn't turn back at the screen to see the name of my company, right? Climate Impact Partners is not something you hear often in this room. So I've worked in software for about 10 years in Bay Area, and very recently I started working with Climate Impact Partners. That's we work with big projects to make sure there's opportunity to offset the damage that we are doing to our climate. I mean, I'll talk more about it because some of Aman's questions kind of elicit that a little bit more. But as Jack said, I'm in that 10 years of enterprise SaaS space. And instead of going to the direction that some of you guys did, right, to blockchain, more sophisticated tech stuff, I moved back to slightly more what I'll say close to the earth piece as we talk about. So that's my story.
Dave, you're on next.
Well, my background is capital markets, primarily worked in energy markets specifically for the last 25 years of my career. So I have firsthand experience with a lot of the high methane producers and oil sands projects that occur here in Canada. So been there, seen them, and aware of the implications of our global demand for oil and trying to manage carbon reduction efforts as well. So a lot of interesting things going on here in Canada from both a energy transition perspective, as well as a lot of energy transformation where we're trying to revamp our power generating grid from being coal-fired to certainly less intensive use of methane for power generation, and then also conversion to solar and other renewables like wind.
Excellent. So I know there were a few questions in the previous panels about environment, sustainability, et cetera. So why don't we turn it over to Sonia? And Sonia, what's your journey been into the environmental space? And I think it would be interesting from an audience perspective to know a little bit about the value chain of how you guys are looking at carbon assets and investing in projects that are carbon neutral and so on and so forth. Because that's where exactly the real world starts to intersect with technology. And that'd be a good way to kick off the conversation here.
Maybe let's start with what's a carbon offset, right? What does a carbon offset mean? So very real, Aman and I commuted here in a vehicle. We saved some pollution because we were carpooling, and Dave didn't. But if all three of us landed here, we'll be emitting carbon in the atmosphere. What a carbon offset project does is it looks at corresponding opportunities to either avoid an emission, and we can go into a little bit more detail later, or remove a carbon from the atmosphere. There are two different kinds of projects. So what we work together is these kind of projects are developed in a lot of places in the world. We are close to about 30 countries that we work together with our project partners with. And while we get to the more complicated terminology of net zero, where we are not emitting any carbon in the atmosphere, where all of us evolve to that kind of, status in life or that evolve, we help companies, the emissions that they cannot avoid today or cannot remove today, how do we offset them to places at other places? And maybe that's a good point to pause here, Aman, for your next question.
So, and I know that as a company, you have set an audacious goal of removing 1 billion tons of carbon by a certain time, I think 2030, right? So, so is this all based on removing carbon from the atmosphere, or is it also avoidance of carbon?
It's definitely both. And the reason is when it's like a crawl, walk, run approach, right? You cannot be a high jumper. And it's us as a company or us as a society, for that matter, as a civilization. We cannot stop emitting carbon tomorrow. And neither can we just extract all the carbon and reduce the 1 degree Celsius temperature that we increased in the last 100 years or so. Both of them are not going to be a one-step process. So we do both removal and avoidance. And we work with project partners of both kinds, which means some of them, and if I can point to Aman, what you and I were discussing in our conversation together, you showed us a very sophisticated portal of renewable energy on the chain, right? And that will be a typical example of an avoidance project. If somebody was using a fossil fuel generated energy, for that, instead of that, they start using energy generated from a renewable source, they're avoiding that carbon emission, and that's an avoidance project. And we partner with a lot of projects in the world to make solar panels happen or those kind of things happen across in places which are developing today. And therefore, the level of energy there is far less. And we can start the journey right? If there's 1.7 billion people in China, 1 billion people in India, about 2-3 billion people in Africa, which are just starting their journey on developing or development and getting access to energy for it. So why don't we just start that right?
Sure. And Dave, you've spent the last so many years looking at and working with projects of all different kinds, not just in solar, but I also know about your hydrogen pursuits and other things. So as somebody championing new technology in the space, how are you looking at the voluntary carbon reduction markets?
Well, it's interesting because I got involved in this whole carbon initiative as a result of some inquiries I was getting when I was doing some energy consulting, and I was assisting a independent power producer here to convert their coal-fired fleet to natural gas. And somebody started to ask me about carbon markets, given my market experience. And once I got into analyzing the various aspects of both compliance or more regulated carbon markets and also what's going on in voluntary markets, I realized that it was way more complicated and way more opaque than I would have thought. We've been at this for 25 years now in voluntary markets, and I was struggling to figure out what was going on. So whenever I see challenges like that, I also see a business opportunity to clearly make it easier to encourage participation in the market, especially amongst smaller and medium-sized businesses that right now are being asked a lot of times as a result of supply chain requirements. For example, you're running a small trucking company, you're providing services to a large company that has a well-documented, well-stated carbon reduction strategy, and they're saying, okay, tell us what your scope 1 emissions are, your direct emissions from your trucking operation. And they are struggling to be able to articulate what that position is from a carbon emissions perspective. So we created Carbon CX to really assist a whole range of enterprises in being able to accurately record what their carbon reductions are, report on them, and then assist them ultimately with the monetization. And by using digital tools and expertise that you bring with your experience, Aman, we've tried to reduce the friction in the business, because right now carbon markets are consultant heavy. They are, there's a lot of, as I said, opacity in terms of what the customer knows versus what the principals in the market know. And by creating more transparency, we create more efficiency, reduce costs, and hopefully garner more participation across all levels of carbon reduction efforts.
Yeah. So you used a couple of terms there, opacity and transparency, right? Those are, I think, in today's world, desirable traits to have more transparency as opposed to opacity.
Correct.
From that perspective, what, and also a little bit earlier in the session, we heard from somebody that almost 95% of Vera generated assets last year were deemed not truthful in a way, right? So what is Carbon CX doing differently? And if you can answer that without using the word Web3, that would be awesome.
Well, certainly what we're trying to do is utilize data and really focusing on projects that are utilizing technology, generating data, and how can we accurately record that data, store that data, analyze that data in terms of what the carbon reduction impact is, and then ultimately transparently report on it. So, there's a lot of different carbon projects that have come under scrutiny. A lot of those are related to, long life projects, forestry projects, for example, afforestation, where they're planting new forest where forest didn't exist. Those are difficult to assess what the true carbon reduction impact is, and often those projects are associated with some of the terms that Sonia and I hate to hear, which is greenwashing and things like that. But clearly, if we can be focused on data and we can get that data from source, and if analyze that data as quickly and as accurately as possible, then we're able to reduce the go-to-market time between when a project is actually, a solar farm, for example, has displaced a dirty coal-fired grid, reduced the power requirements from the grid, replaced it with on-site solar. We record the hours that the solar is operating, do the calculation on what the carbon reduction impact is, and seamlessly then take that all the way through to the ultimate creation of the carbon credit.
Awesome. So let me shift gears to Sonia here, right? So Dave, you talked a lot about the data side of it. Now the question is, when I started to look at these carbon markets, to me, it seemed like a ton of carbon is a ton of carbon, right? And it should be priced the same anywhere in the world on any exchange and so on and so forth. But turns out it is not, right? It really depends on a number of factors that go into pricing these assets differently, and avoidance versus replacement. That's probably one side of it. Can you shed more light on how these things are priced in the market today, Sonia?
Sure. So Dave talked a little bit about the journey of a carbon credit, a typical avoidance carbon credit, right? Once you have electricity or power generation, which is a lot more easy to calculate. And this was a complex step that he explained. This is the easier thing to calculate because you can see how long is a solar panel running and how much electricity was getting consumed.
Right.
This is an avoidance credit. We're going to use that kind of power, which is going to come from a fossil energy source, and we are moving to a renewable source. The other side, which Dave hinted at, it's a lot more complex calculation. You're saying is, let's say the forest cover, I'm making these numbers up. In United States is about 10%, and we deforest at the rate of 5% per year, and therefore the carbon that was going to be absorbed by that 5% or 0.5% of trees is now going to be emitted. And then you have a forestry project, which takes the trees, if it is redwood, probably takes 300 trees. If you're having a simpler tree, it takes them 25 to 30 years to grow to a maturity. So you're doing a very sophisticated calculation saying, I'm planting this many seeds, this many trees will grow in a soil of this kind, and therefore they'll absorb this much carbon from the atmosphere, and that's the value of offsets getting generated. There are a lot of assumptions in that model, which is typical of a lot of assumptions in any asset model. When you're doing financial analyst, in my past life, I was a financial analyst, I was doing financial valuations. These kind of models are super complex. And then you're throwing Mother Nature's vagaries in, right? Sometimes it rains, sometimes it doesn't. Sometimes the soil is this kind or that kind. So that is why evaluating carbon offset is a very sophisticated predictive science, which requires experts. There are soil experts. So those kind of things contribute to the price differences. That's one. Mm-hmm. That's an avoidance offset is easy to price, more standardized, the energy ones. The removal offsets, forests, afforestation, reforestation, have different prices. The third thing that comes in the picture is most of the projects that we're talking about also have some impact on the society, what's called UN's social development goals. And most carbon project developers, because of the markets they operate in, if I'm working in Africa, I'm looking at, is my project increasing the livelihood of the society? Am I planting a forest with some fruits which the farmers can sell? And there's additional value to that project. So there's a very layered space of how a project is evaluated. And then there's a supply and demand equation, because you need to offset where you are generating and whether enough credits available or not. So those are.
And these pricing variations are not minimal, right? So a ton of avoidance credit is probably $5 a ton, but a ton of reduction credit can be as high as $100 a ton. So companies really need to think about what they're doing in terms of their ESG strategies. And Dave, that's where I want to pivot to next is, given these variations, what are you seeing when you're talking to your customers and potential companies working with? How are they looking at their carbon reduction and net zero strategies?
Well, it depends on if they're carbon buyers, so they're buying carbon credits, they tend to be price motivated. If they are carbon credit sellers as a result of projects they're involved in, they tend to look at more of the intrinsic benefits associated with the project. So you end up with a bit of a market dynamic then between buyers and sellers. But the one thing that I always encourage market participants to do is really to define what it is they're trying to accomplish in their carbon strategy. So, what's their motivation for deciding to participate in carbon markets? Is there a compliance or a regulatory requirement that the industry is putting a cap on your emissions, for example? Is there demand from stakeholders within your organization? They could be shareholders, for example, that are coming to protest at your annual meeting, demanding that you do something about your carbon footprint. And certainly we're seeing headlines, and all the oil and gas companies have been facing those kinds of challenges. It could be your financial partners. It could be your bank, for example, that's withdrawing from certain aspects of lending. We're seeing that, all over the world, where banks are no longer lending to coal-fired generation projects, for example. So if you want to build a coal plant in North America, you will have trouble finding bank financing for that, likely. Or is it, the customer that's ultimately driving the requirement? They want to see you, if you're operating an airline, for example, reduce your carbon footprint, provide alternatives for passengers to mitigate their carbon footprint associated with travel. And so I guess it's really important to understand what those drivers are, and then understanding the drivers allows you to spend your money more effectively. And that could be making the world a better place, as Sonia indicated, where there's significant benefits, and I've seen them firsthand with projects in places like Africa, where the spill down effect is tremendous in terms of the work that's being availed on the people there, and the quality of life implications by turning off a lot of the dirty generation, and reducing the power demand and those kinds of things. So it can be very impactful. And other times it's a case of wanting to support companies that are introducing new technology. I mean, we see it every day where companies are knocking on our door where they have this really cool energy storage technology using supercapacitors, for example, and they don't know how to get matched up with the generator company that, for example, that's generating. So we end up, providing a lot of those introductions, and kind of working at the nexus of a lot of those different markets. But it's very, very dynamic. And as I say, figuring out why you're in the market, what you're trying to achieve is key. And then when you work with professionals like Sonia, she can help you, more accurately define what kind of offsets you need to be looking for, or how you need to structure your own program if that's the direction you're going for your company.
So for companies like Climate Impact Partners, one of the motivations is also to see that the projects that you're bringing carbon avoidance or reduction mechanisms into also have a secondary revenue mechanism by selling these carbon credits in the markets, right? So is that a big motivator for when you look at projects to see what the real outcome from a revenue generation standpoint is?
Yes. I mean, what it does for our project partners, I mean, we work with a lot of project partners, and then we're now also getting the space of building our own projects. But the intention is, how do most of the companies in my space wouldn't say that. Everybody thinks about what kind of benefits happen to the community on the ground. That's an important factor in thinking. It's the corporates get to offset their credits while they get to net zero stages. What benefits happen to the community? So in my brain, carbon finances and voluntary carbon markets, as I see them, there's a lot of community and social involvement and a social good involved in the practice itself.
Yeah. So switching gears onto the buyer side of it now, right? Now, what's the incentive for buyers when they buy these credits? What are they supposed to do with it? And how are they thinking about retiring these credits as well? And what is the process that they go through? And this is also important to understand, because this goes to the heart of making data transparent, because the sell side data is often available. So especially if it's a solar plant or something like that, right? But on the buy side, how does the retirement side really work? And that is something where we can definitely bring more transparency by putting all of that data on chain and letting people draw their own conclusions about a company's carbon footprint and their offset mechanisms.
Let me tell you how things happen today. I wouldn't say it's not completely opaque. There is stuff that happens. There are 4 big registries. I mean, there are lots of them, and I see more digital registries coming into the place. But Vera and Go Standard are the 2 big carbon registries, and RECs, which is Renewable Energy Credit, or International RECs are the 2 big registries for avoidance credits of power generation. And when you buy an offset, you basically it's an offset, so it matches to the 1-year emission of a certain year. And then you retire that offset for that particular year. So, I mean, let me step back from that a little bit, right? You asked me, why do companies do this? It's like what they do, but let's step back from that. Why do they do it? Part of it is some of them are motivated by change. Some big companies, if you look at Microsoft's website, for example, they've been doing this for about, I want to say 14 years that I know of, maybe longer. They're one of our partners. But a lot of companies think through their impact as they grow bigger, and they root for their own reasons. That's the voluntary reason to offset, because the other piece of it, this is a regulation. If those of you who saw in the last 2 months or so, SEC came out where every company had to disclose what kind of emissions they were making. There was a little bit of vague requirement, but SEC was very specific about scope 1, scope 2, scope 3 emissions that need to be disclosed in their financial reporting. Companies that knew this was coming, it's been discussion for a while, but doing it anyway there. But now that risk is going to get measured, tracked, reported, and priced in. Like any law that happens, there was some pushback and there was a debate, and then the law might change. but some states in the US and a lot of international countries for that matter.
EU, for example.
Yeah, California has law where the companies need to do this anyway, federal laws apart. France, Europe is far ahead in the regulation. So there's a voluntary desire when you're a good corporate citizen, you're big enough, and then there is a legal reason to do it. The second step that we were talking about is how do you do it? You can see what a company used to offset on some of these registries' website. That said, the level of data available varies by project type and other complexities.
Mhm. Sure. And I think that's exactly where bringing that data on chain is so much more important, and making it transparent is very important as well. We'll take questions in a couple more minutes, right? I'm almost winding up here as well. So it's important for them to comply and be good citizens. And at the same time, it again, from a compliance perspective, having that data on chain is necessary. But what we are finding as we are working with a lot of these companies is a lot of that data is very proprietary and it's private as well. So how do you put that in a public domain by putting it on chain or having it verify? And this is where I think the Carbon CX platform really does a fantastic job in keeping private data private and bringing out the verified elements that are vetted together, right? So Dave, we are short on time, so if you can keep it quick on that.
Yeah, as you know, I mean, we tend to be very project focused. So we'll take a lot of disaggregated data, and then for purposes of reporting or recording on chain, we aggregate a lot of that data. You don't really see the individual sites, for example, and the actual usage at each site. We have all of that data available if someone were to sign an NDA or wanted more details on the backing of that credit. But generally, we operate on an aggregated basis, and from the top level report what's gone on, for example, for the last quarter for a particular region in South Africa, for example.
Mm-hmm. And you're also working with auditors.
Correct. And to try to meet audit standards is another whole requirement in some cases. So,
yeah. So just to wind this conversation, and I know there are a couple of questions in the room too. So what are the top things that companies should start to do today in order to meet their net zero goals by, say, 2030? I know it's still 6 years away, but seed sown today will go a long way. And we're already starting to see that come back in a huge way in the sports industry. I know Formula One wants to have a net zero footprint by 2030. And coupled with that is DHL on the logistics side. They've publicly stated they want to do net zero by 2030. So each one of you, just some quick parting thoughts on what companies should be doing and how should they be looking at their ESG strategies. Yeah.
Sure, I'll go first. So since my title, if you expand it, say strategy and operations, so let's focus on the operations part of the role. You cannot eliminate what you can't measure. So your first step, if you don't do it today for any company, is how do you measure your scope 1, 2, 3 emissions to know what you have to eliminate? That's like, in my brain, that's like the first step. You measure and then you look at which partners do I go with and what do I need to do today and what's the next step and what's the next step. 6 years is actually pretty short, and don't consider an advertisement for my company. It doesn't matter which you go with. The amount of time it takes to put together a strategy of this kind, I actually think 6 years is too short for most of these companies. They are hoping, this is me making stiff up or thing, that deadlines will get expanded, which is a possibility, but there's not enough time is how I think about it.
I'd recommend taking a risk management perspective. Working for financial institutions in my career, all very risk management focused. And as Sonia indicated, it's hard to manage what you can't measure. And so that is clearly the first step. I'm in complete agreement with her in terms of identifying where you've got risk associated with emissions, with your operations. And then it's a question of bringing in the professionals that can assist you with re-engineering some of your processes, for example, to reduce emissions, changing the way you run your logistics or do other things there is lots of different operational improvements that most organizations can make from an efficiency perspective. And Amazon's spending lots of time on the last mile efforts right now. And so I would say view it as a risk management exercise. Get somebody into the organization that has that experience and that mindset to be able to identify where those risks lay, start to articulate them, talk about them, and then you can measure them.
Okay, fantastic. So we have a couple questions in the room, I think. So if you want to go ahead. Olivia. Sure.
We've known about this, and we've had people that are believers, people like yourselves that have been doing stuff, but we've had a very difficult time with, one, getting funding to implement it, two, getting corporations and decision makers to back these initiatives at large organizations. You look at New York, where they have local law 97, where almost every building over a certain size must report and also buy carbon offset. But we're staring these things down. We know they're coming, but I've been having a hard time getting traction in the industry to actually get users to own this stuff, get people to be able to use the data and be able to use the tools like a Carbon CX to be able to show the data. And so my question is, where are you seeing the actual traction occur today, and how can we push on those key friction points so that we can really open this market up to what we all know is the obvious answer, but in May of 2024, we're not seeing the data and returns?
We are all walking the same path and living the same journey, unfortunately. I often comment it's easier to get somebody up in Lagos, Nigeria than it is in Houston or Calgary to talk about carbon reductions in the energy business. So I would say we are seeing from a voluntary perspective and what we're doing with Carbon CX, big uptake in South America, big uptake in Africa and Europe, more challenging in North America. I think that's because we haven't necessarily articulated a good path. There's been, certainly in North America here, there's been the regulated paths associated with what's going on the West Coast, California, the low carbon fuel initiatives, those kinds of things. But if we're going to wait for governments to sort this out, then, it's going to be a longer process, I think. That there needs to be either a compliance requirement, as SEC is starting to undertake, and I expect that the Canadians will follow suit here shortly with that. That is certainly going to assist in pushing people and motivating people. But I fear that there's going to be a bit of a land rush mentality when all of a sudden it's staring everyone in the face and they realize that there's just not enough companies that are there available to evaluate carbon footprints, and certainly not enough opportunities for them to mitigate some of that risk. So I think you're identifying a looming problem, and I'm open to all ideas to get more participation in the market. So Carbon CX, we're trying to make it easier. We're trying to make it simpler to engage with our platform, to record your savings, and to capture the incremental reductions. Sometimes it's not the big transformative projects that we need to be focused on, but rather the trucking fleet that's improving their fuel performance 10 or 20%, improving their bottom line, reducing their fuel costs, and as a result, reducing carbon.
So that's the external perspective from Dave, right? If I look at internally, which stakeholder should you appeal to? That's how I took your question as. Who do I go? Which door do I knock where people listen that this is something I should care about and fund, right? There are two titles that I think we have had. One, we've success with, and the second that I see getting impacted more and more. The first is the Chief Sustainability Officer. So if we look at our companies, if you're looking at target clients, those which have a Chief Sustainability Officer or an ESG department, they are the ones which are more first to align to like the voluntary requirements. The second department internally that has the highest voice and risk is the CFO's office. mean, if you tell them your registration, your cost, your risk to this law that is coming, in this and my previous roles, that is the department we have appealed to from that risk management perspective.
And then from the funding side, you have a lot of people in this room, a lot of people, I'll use Web3, you told them not to use it, but I'll use it. A lot of Web3 entrepreneurs that are leveraging the technology to be able to build carbon forward solving for UN SDG type goals. There's a disconnect right now because you have things that are generating revenue, initiatives that are generating revenue in Web3. I'm not going to go into some of the crazier ones that we're seeing today. And then you have very mission aligned groups that innovators, entrepreneurs that have taken this up, and revenue is not there right now. And you look at investors and they're like, oh, that's generating revenues through XYZ. We may not align with it versus this conversation. I think everyone here aligns with that, but the capital is not going in there to support those initiatives. So how would you recommend innovators and entrepreneurs to solve that current disconnect that we're seeing in the market?
Okay, so the way I look at it is, and first of all, a quick note on Carbon CX. This platform is entirely a Web3 platform, takes away all the complexities and abstracts it out into a bunch of different token formats and provides the adequate transparency at a project level completely, right?
I wasn't allowed to use Web3, you said.
I know, I'm moderating here. So, but to your point, I think the way to make money in this space will require more than the tech or the other ancillary markets. It's a business model innovation question here, right? Can we innovate on the business model side of it so that when you're looking at it from a risk perspective, the CFO's office is aligned with you, and so is the sustainability officer aligned with you. And then the tech kind of just becomes a vehicle for enabling that. And in that trifecta, I think it's going to be, the winners are going to be who can innovate on the business model side of it by showing that this is the risk that you've avoided versus this is the value that you've generated for yourself. And I say this because we were also involved in a biogas project where the company thought that they had $100 million worth of IRS tax credits. They had the data to support it, but at the same time, they were only able to sell it for about 52 million. Why? Because the risk was on the buying side, where they were not fully sure that they could get the 100 million in tax advantage that they were paying for, right? So that was a big arbitrage opportunity. Now, how do you bridge that? I think that's the open question on what can you bring in from a business model innovation to make that happen. Yes, sir.
So I guess my question is more around, I'm a real estate developer, and there's been a lot of conversation in the Inflation Reduction Act regarding the repurposing of assets. And we're seeing the capital markets move to this space that you're speaking to. But can you speak to, I think probably more particularly you, do you assist in the capital stack when you're buying a legacy asset and repurpose it to become more energy efficient? Do you assist in that kind of conversation, how the capital markets are moving in there?
So the way voluntary carbon markets work is we bring finance to projects, but a lot of time that happens when projects have reached a certain level, right? They start offsetting, which means the project have reached a certain level of maturity and to grow to the next stage. But we do work with, I would say, tens or at least hundreds of project partners globally. The other part of your question where I was going with this is, there's some projects that we support from the start. It's a small, very small group where we build the project from the start and we work with some investors to bring that to market. But that's a number like in low single digits because of how long the horizon of building a forest with a dam and a water body and all those things gets to be.
questions?
Well, in that case, let's take the quick break and come back for the next session here. Right? Thank you, everyone. Thanks for joining.